Good afternoon, everybody. Thank you for assisting to this webinar presented by SSQ Insurance. My name is GIF Buckingham, Investment Fund Analyst at SSQ. We are pleased to welcome today Edward Keating, Client Portfolio Manager at Lazard Asset Management, here to talk their global infrastructure strategy, their positioning and outlook for the portfolio. Please note that if there is enough time at the end, it will be our pleasure to answer one or two questions that you can ask via the WebEx interface. You can also communicate with your SSQ insurance representative for all other questions. So without further ado, Edward, the floor is yours.
Wonderful. Well, good afternoon, everyone. Thanks very much in advance for your time. I'm certainly very happy to bring you an update on the listed infrastructure in which we manage on your behalf. Before I dig into infrastructure, just a few notes on page 1 with respect to Lazard Asset Management. We are a global asset manager, as you see here, with offices around the world. We date back in terms of our history about more than 150 years, headquartered here in New York. We manage now a bit more than $200 billion US dollars. So infrastructure is something we've become well known for. And Lazard very much is well known for global and emerging market long-only equities. On the following page, page 2, a reminder of what we do within this portfolio. We seek a long-term and very defensive, low-vol profile of returns by investing in what we call preferred infrastructure. What preferred infrastructure means to us is that these are monopoly infrastructure companies around the world that offer essential services and do so within a political and regulatory environment where we have a higher confidence with respect to respecting private capital. So generally what this means for us is that we invest predominantly within the developed markets. Now, we target a long-term performance objective of inflation plus 5% over 5-year periods. So think of this investment strategy as sitting neatly in between your fixed income and your equity allocations. We are a value long-only manager, and we manage a fairly concentrated portfolio of 25 to 50 investments. We do hedge this portfolio back to the Canadian dollar in a passive manner. We launched this business in Canada about 12 years ago, and in total assets under management, we manage about 16 billion Canadian. On page 3, you see our investment team, which has not changed. Still the 6 individuals that lead this portfolio. We are located around the globe in our Sydney, Australia, our London, UK, and our New York offices, and we get to plug into the broader resources of a large organization as Lazard Asset Management, but no changes to our investment team. Nor are there changes on page 4 to our investment process. And as an overview, what we're trying to do is look at the entire world of infrastructure companies, filter them down to a select set of companies that we believe are on the higher quality, more predictable, and certainly lower risk end of infrastructure assets. These, therefore, are those preferred infrastructure companies. Today, there are roughly 90 preferred infrastructure companies around the globe. We then, as value managers, look to value those cash flows to find 25 to 50 of the most attractively priced preferred infrastructure companies and build a portfolio that does not pay attention to benchmarks. As ultimately we are bottom-up stock pickers and manage this portfolio without constraints with respect to a benchmark, and it is predicated on delivering returns in excess of inflation plus 5% over 5-year periods. And what you see on page 5 is a very colorful chart. This is our universe. So each one of those bars on page 5 represents the expected return of each company in our universe. So each bar is an individual stock. And what we've charted here are the 3-year annualized expected returns for each one of those companies, which means the companies on the left-hand side are quite attractive to us. They have very high return expectations, and this is where we concentrate the portfolio. The stocks on the right-hand side have negative return expectations. We seek to avoid investing in those companies as we believe their share prices to be expensive today. So our investment process is predicated on investing in the companies on the left-hand side of this chart, which explains, too, why we manage a relatively concentrated portfolio today of approximately 30 investments. You'll also note that on page 5, the colors of those bars represent the sector in which the company focuses. So you will see that there are several communications infrastructure companies, several toll road companies, some electric and diversified utility companies as being attractive to us. And as you'll see in a moment, we have large allocations in those sectors because the stocks themselves are attractive. On the following page, on page 6, you'll see the value rank by country. So now this is the same information, although the colors now represent where the company is domiciled. And what might be very interesting, or what might jump off the page here, is that on the right-hand side, the expensive area of our universe, there are lots of U.S. companies. So each one of those red bars represents a U.S. company, which spells out our thoughts today, our views today, that the U.S. is one of the more expensive places in order for us to invest, which also explains why we have a very small allocation to the U.S., as you'll see in a moment. Now, the companies that are attractive, the ones on the left-hand side, predominantly are in Europe. Thanks to things like Brexit and referendums and canceled elections and the general volatility we have seen within the markets of Europe, it has maintained some very attractive investment opportunities for us, which explains why, too, we have invested the vast majority of this portfolio over in Europe. And you'll see on page 7 how the portfolio is allocated. So on the left-hand side, you'll see the portfolio on a country basis. So as I mentioned, most of the portfolio is outside of North America, with only about 22% invested across the U.S. and Canada. We maintain a 5% cash position, but the balance of the portfolio are in large allocations in areas like Italy or the U.K. And on the right-hand side by sector, large allocations to tolled roads, electric and diversified utilities. Both of these pie charts highlight where the portfolio is allocated, but I think it is important to note that we as a team do not make macro decisions or top-down calls or sector calls. We're bottom-up investors, so these allocations are a fallout from where we are finding the most attractive infrastructure opportunities today. Now, while the portfolio is relatively concentrated at around 30 companies or 30 investments, I think it's interesting to note that on a look-through basis, if you look through to many of our infrastructure investments today, those companies own more than one underlying infrastructure asset. So on that look-through basis, you actually get substantial diversification with more than 200 infrastructure assets ultimately exposed to within this portfolio. And some of those companies you'll see on page 8. So shown here on page 8 are our top 10 investments. A couple of things to note here. We have more than half of the portfolio today invested in these top 10 positions, as they are among the most attractively priced and therefore having among the highest return expectations within our universe. Most of them are in Europe, with the exception here of Norfolk Southern, one of the large railway assets of the U.S., as well as Transurban, which is Australia's largest toll road company. But you'll see some substantial investments in specific companies in Italy, as well as France and the UK. As a reminder, these are stock selection ideas of ours. These are stocks that we believe have very high return expectations for our investors on a forward-looking basis. From a return standpoint on page 9, you'll see that the last quarter was a very good quarter with respect to absolute returns. Your portfolio was up nearly 10% in the quarter. Now, to put that into context, this is an investment strategy, as I mentioned earlier, that targets a return of inflation plus 5%. So roughly 7.5%. And in one quarter, we've done nearly 10%. So given our style of management and given the asset class in which we invest, a return of about 10% for a quarter is very, very good. And we're certainly proud of our longer-term track record as well. Over the last 3 and 5 years, delivering annualized returns of around 12% per annum and just over 8% per annum since inception. And again, well ahead of our long-term objective of inflation plus 5%. On page 11, you will see some of the drivers of return in terms of the last quarter and the last year's worth of top contributors and detractors. On the contributors to return for the quarter, Atlantia, which is an Italian company whose dominant asset is the Autostrade, a tolled road network in Italy, was up about 23%. Atlantia was one of the companies that detracted from returns last year. But given some very positive things with respect to asset sales within that company and an agreement between the Italian government signing on with the Chinese development business on Silk Road, the infrastructure investment and development company, alleviated some concern with respect to the Italian government revoking the concession that Atlantia has, which goes back to a bridge collapse in Genoa in last August of last year. So the company, the share price rallied as investors became quite excited, or at least less nervous about a negative outcome stemming from that road collapse. Norfolk Southern rallied quite strongly in an equity market that did well. Norfolk Southern, as a reminder, is one of the U.S.'s largest freight and commercial railway company, rallying about 25% in response to equity markets doing well and also continued good earnings. Snam and Terna are two more Italian companies. Snam is a gas distribution company, while Terna owns the electricity transmission grid of Italy. They continue to benefit from very positive outcomes on the regulation front, and they're spending considerable amounts of money in order to further develop and further grow the regulated asset base, which should create some very good returns and growth for these businesses down the track. Vinci in France, one of the country's largest toll road owners, continues to perform well as traffic across its toll road network and airport investments continue to perform quite well. Now, on the detractor side, the largest detractor from return was PG&E, a stock that we also exited over the quarter. PG&E is Pacific Gas and Electric, California diversified utility that was at the center of over concerns stemming from the wildfires of 2017 and again 2018 in the state of California. Ultimately, due to the potential liabilities stemming from those wildfires, PG&E voluntarily declared bankruptcy in January of this year. Due to those bankruptcy proceedings and the risk thereof, we no longer see PG&E as one of those preferred infrastructure companies, made the decision to remove the company from our universe and sell the position out of the portfolio. It detracted approximately 200 basis points from returns over the quarter, in the first quarter of this year. SES and Eutelsat are two France-based satellite owners. These are wonderful businesses that own both geostationary and high-throughput satellite assets. They also form the consortium that owns the C-band spectrum that will most likely be used in the rollout of 5G communications and technologies here in the U.S. These companies have been subject of great excitement as they were good performers in the portfolio last year. The market softened their stance on both companies in the first quarter of this year. We believe their values have not changed. We continue to invest in SES and Eutelsat and see them as two of the most attractive companies in our entire universe. In fact, they continue to report in line or better than consensus earnings and revenues, and yet the market seems to be concerned or their concern seems to be overblown over their outlook, though we remain invested in both of those companies. There was no stock-specific issues with respect to Union Pacific, which is a company that we just initiated a position in this past quarter, or Red Electrica, which is a business over in Spain. Red Electrica owns the electricity transmission grid of Spain, though we remain invested in both Union Pacific and Red Electrica. On page 12, you'll see the transactions in the quarter, where some of these I've mentioned earlier, where we added to Hong Kong-based Power Assets Holdings, which is a diversified, mainly electric utility company in Hong Kong and in Asia. Union Pacific, which is one of the largest freight railway assets here in the U.S. It is based on the West Coast, so its service territory is on the western part of the United States. The complete cells were PG&E, as mentioned earlier, and Edison International, which is another California-based utility company in the southern part of California, based near Los Angeles. We had increased our discount rates on Edison International. As a result of that, the value of the company changed, and we exited based on relative value investment decisions. On page 13, you'll see that today's portfolio trades at fair value. So what this chart is showing is the fair value assessment of the current portfolio in which you're invested. I think it's important to note that when you invest at fair value in our preferred infrastructure companies, you should expect a return of inflation plus 5%. So which means today's investors, or at the end of March, capital invested in this strategy, a fair return expectation over the next 5 years still is inflation plus 5%. Now, we caution investors because the most recent history of the last 5 and 10 years, returns have been well in excess of inflation plus 5%. We still maintain the feeling that this is a very good place to invest, but I think investors should ratchet back their expectations for those returns, and we think a fair return expectation for this portfolio today is inflation plus 5% over the next 5 years. And on page 14, I'll leave you with some bullet points on outlook. Some of this information will be repetitive with respect to the information I shared earlier. But the first bullet point, I think it is very important to note that the strategy has performed exceedingly well over the last decade plus. We're certainly proud of the returns and what the strategy has delivered for our investors. Though, as just mentioned, we need to caution our investors to reset those expectations more in line with inflation plus 5%. Now, this is also an investment strategy that has provided very good defensive returns for our clients, one that still enjoys very strong inflation protection and has a very attractive yield component. Also, it has performed with approximately half the equity market beta. So we believe that today, for investors, owning this portfolio with a return expectation of inflation plus 5% and still getting all of those nice benefits of lower risk and defense, good yield and inflation protection and low beta, we believe it's actually quite a good place to be, especially relative to other asset classes around the globe. Infrastructure equities in this portfolio has done well by investors, but over the last decade or so have equities. It's become a challenging time for investors to find low-hanging fruit or investments that are exceedingly attractive. So we caution investors to note or to reset those expectations for this strategy on a going forward basis, though we're actually quite confident that it is a very good place to be, particularly relative to other major asset classes, which may be quite expensive at this stage. But with that, those are the end of my prepared comments for this call. I am certainly very happy to open up the call to any questions that there may be.
Thank you, Edward. We'll now proceed to answer some of your questions. So we have one question in the Q&A section, which is, what is your vision on dividend yield for portfolio construction?
So the dividends in which our companies pay are clearly quite attractive. So today's portfolio yields approximately 4%, which is quite high relative to other asset classes or other yield-oriented investments available to investors today. When it comes to our portfolio construction, however, we're not out there targeting yield as an investment criteria. In fact, we own several companies in the portfolio today that pay very low yields, although we believe the total return available to investors in their shares are quite high. So yield is an important element in our portfolio construction, although it is not the main focus of our portfolio construction.
Great. Well, thank you for very much, Edward. It was very interesting. So this concludes the presentation. To all who have listened to the webinar, thank you for your participation, and come back at the end of May for the next webinar with AlphaFix. Thank you.
Parfait, merci Jean-Philippe. Donc, c'était très intéressant. C'est la seule question qu'on a eue. Donc, ceci va conclure la présentation. À tous ceux qui ont écouté le webinaire, merci de votre participation. Puis revenez-nous à la fin avril, alors que l'équipe de Lazard nous fera une revue des marchés et parlera de la performance de son fonds d'infrastructure locale. Donc, merci beaucoup. Bonne journée à tous.